What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights Podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What's up, everybody? I'm back with another edition of the Macro Insights Podcast. And for those listening on any audio or video, feel free to hit that subscribe button to get the next Macro Insights Podcast directly to your feed. Give it a 5-star rating. If you're listening on Podcasting 2.0 apps such as Fountain, give it a boost. Give it a like and give it a comment. Let me know what you think about all these episodes, and it definitely helps me bring in quality guests. But first, before I introduce my guest, I'd like to shout out to my sponsor, Idaho Armored Vaults. You can find them at goldsilvervault.com. So go ahead and check them out because Bob Coleman, he's the man. He's the myth. He's the legend. I actually am interviewing here shortly, but he's been an investment manager in the industry since 1992. He founded Profits Plus Capital Management in 2001, and he did much, much more. But Idaho Armored Vaults has been around since 2008. They're there to help you protect your financial assets, provide property outside of the financial system from numerous risks, including systematic and counterparty. And it is uniquely vertically integrated to structure, procures, transport, stores, and provides extensive liquidity using physical precious metals such as gold and silver. So go ahead and check them out at goldsilvervault.com. That's goldsilvervault.com. And tell them Green Candle sent you. And I already did a little spiel here, but I do have Bob Coleman, the founder of goldandsilver.com, Idaho Armored Vaults. Bob, how are we doing today, man? Welcome to the show.
Good, Brandon. Thank you for having me.
All right, man. Well, so I gave a little spiel. I stole your thunder a little bit, telling a little bit about your background. But why don't you get into it? How did you get to where you are today? And tell us a little bit about your background.
Yeah, definitely. I've been in the financial world, I guess, my whole career. Got into the business in 1992. In 1993, actually, originally I took all the licenses with IDS Financial Services, which was basically a financial planning organization, I guess, taken over by American Express. But didn't want to be an insured salesman. So I got into with Dean Witter back in 93. That eventually got taken over by Morgan Stanley. Then I left, went independent in 98, and then started my own investment advisory firm in 2001, and then also started a hedge fund back then as well. My RIA, or registered investment advisory firm, is Profits Plus Capital Management. And then basically 2006, we kind of saw the markets leveraging up, and I was getting extremely worried, and started really researching how to hold your assets out of the system, and then what assets actually hold. And so gold and silver made a lot of sense to me at the time. There wasn't a lot of depositories to choose from. So when I did all my risk analysis and so forth, ended up nothing ever, no depository actually met really my long-term goals, I guess you could say. So I ended up starting my own depository business in 2008. Our facility went live in 2010. And they've just been growing ever since. So that Idaho Armored Vaults does the depository work. And then also in 2009, I started buying, selling metals for clients. And that now is under Profits Plus Precious Metals. So it's not necessarily a dealer per se. I'm more of like, I call myself a purchaser representative, because we work on behalf of the client to get them the best price. And that's one of the reasons why we beat every dealer in the country in price. It's just we work directly with the wholesalers, and we have a small markup that we have that allows us to sort of pay for some of the insurance and other types of costs to run it, but we don't have these mega markups that you typically see with a lot of online and other retail dealers. So it helps the investor try to get more metal for their money, and it gives them a chance to try and break even at a much smaller rate, because there are premiums associated with physical products, unlike a paper or digital product, which doesn't have any premium to it at all. So you round it all out together, and you just try to build an overall plan for the customer or the client in terms of how to protect their wealth. And then, of course, we insure and store all assets here at the facility. We have a $600 million all risk insurance policy through Lloyd's of London. We also have courier policies, armored fleet that we also can run in armored trucks, high value items as well. And then also we have a freight policy on top of that, so we can logistically help the client either move the assets out of a program or even out of their house, or deliver to their house if they need it. So we've taken delivery from the COMEX, from programs overseas, Perth Mint, you name it. We've helped clients move those assets around, especially from Singapore. We store also in Singapore as well. But it's just, to me, it's trying to build a program wrapped around the client versus the client trying to find a program that maybe best fits their needs, but you're still susceptible to whatever the rules and sort of the guidelines of that program offers. So we try to make it look, or try to make it much more appealable to the client, so we can actually fulfill their certain requests or demands. A lot of our clients are high net worth institutional type clients, that type of thing. So everyone has different needs, so we try to help with that.
Yeah, that's awesome stuff. But the question that comes to my mind is, why the precious metals? Why did you decide to kind of get into that realm? I know you kind of mentioned, you had the traditional finance background, and that was a little bit before 2008. That crash and everything like that. So, did the 2008 crash, or kind of that looming effect of that, kind of have something to do with you getting into it? And yeah, like why did you decide to? I guess I don't know if it's really much of a career switch, but it's more of, I guess, from managing equities to precious metals.
Yeah, what I looked at was when you saw these banks leveraging up. I mean, you had 30 to 1, 50 to 1 type leverage uh, portfolios or businesses like Goldman Sachs, or of course Washington Mutual and all that kind of stuff. When you see that type of stuff happening, and of course we didn't have quantitative easing then. You didn't have all the alphabet programs that bailed out financial institutions and big name investors and other funds that were trapped in the system, so to speak, with counterparty risk and all that type of stuff when 2008 did happen. But before all that, the big question was, you were staring at systemic risk right in the face. And to me, I was like, I don't know how you protect that with a brokerage account, in all honesty. I mean, yeah, you could buy puts on the market, but like we saw with AIG, when AIG failed or was going to fail, they got bailed out just because they could actually settle that trade with Goldman Sachs, for example. AIG was the losing party, and they had to make good, on Goldman Sachs. So, that when you see that kind of stuff, before all that happens, you try to plan the best you can. Of course, crypto wasn't around, Bitcoin wasn't around, anything like that. So, and the metals had 5,000 years of history. So you had a defined asset that had tradition, history. It had already a network effect, so to speak. So you weren't recreating the wheel. You keep it simple, basically. And so when that happened in 2008, obviously that was the right call. It's just that as an investment advisor, I think I'm the only registered investment advisor in the country that owns a depository. And so it was very novel at the time, because most depositories, in fact, all depositories out there, are either owned by a gold dealer, a financial institution, or a cash in transit type company like a Brinks that moves cash or check clearing operations, that type of thing. So they're all designed around transactional business, and the storage business is just a small part of their overall plan. And what I looked at was, hey, if the economy goes down, you don't want to be into a depository that really relies on its parent to pay the bills. And so what I did was look at this thing from a completely opposite perspective. I looked at it from a client's perspective, which is, hey, listen, I've already owned the metals. Now I want to store it with a company that is tied to the hip with me, not necessarily doing its own thing after I've got my metals through them. So it's an odd way of thinking, but to me, it's thinking on behalf of the client first, and then how we can then what's best for us at that point. So it really solves that fiduciary type of obligation, I think, if that makes sense. So when you kind of wrap all that together with the market at the time back then, you were looking at I looked at counterparty risk, systemic risk. You look at the nationalization or confiscation issues that like Bank of Holiday in 1933, for example, when they were calling in gold, and basically that was done to sort of increase the money supply where they could inflate in a time frame where you had the depression going on and they needed to inflate the money supply somehow to try and stimulate the economy. That was really the essence of that. It wasn't really necessarily announced that they were having people turn in their metal for. But you look at I looked at multi authenticity risk, making sure you can get the metals, and then that the facility itself doesn't have any type of obligation to somebody else, doesn't do leasing, doesn't do loans, can't touch the client's metal in case they, whether they have to default on a transaction or choose a defaulting on a transaction versus, hey, listen, I could take it out of this box for a moment and put it right back. I didn't want to have any of that obligation. And so I ended up, sometimes when you got to do it right, you got to do it yourself. And that's basically what I did.
Yeah, that's great stuff. And it is kind of interesting because, yeah, like you said, there was no Bitcoin at that time, or, it was just kind of being, I don't know, quote unquote, invented, however you want to describe it. But so gold, the flock to gold kind of made sense, right? Because like, that was kind of the way that they got out of the 2008 bubble was, essentially just money printing. And then they found out like, hey, we can just do this to get out of any potential crash, and that's where kind of where we're at right now. But yeah, so like, have you kind of seen, I guess, more of a flock towards, I mean, I guess I don't know if you can go into like the full disclosure on how business is doing, but have you seen, I guess, more of a flock towards the precious metals right now, because we're seeing, a giant inflationary push, when it seemed like the narrative was kind of at some point, like, gold wasn't doing super well in the 2020, like 2021 ish time. And now it seems to be doing a little bit better. So, are you seeing more of, I guess, a push towards it now? And why do you think there wasn't, I guess, the initial push towards it when, the excessive money printing was going on initially?
Yeah. Since 2008, well, if you want to go backwards a little bit in time, 2008, 2009.
Oh, we lost you there for a second, but to get you back, basically, I was asking, what do you think, I guess, when you started this and all in 2008, it seemed like 2020 was kind of a similar time where we were going through QE, a lot of money printing, but the narrative around gold was it was pretty stagnant from 2020 to 2021-ish time. And it seems to be doing better now, as far as like the price to dollar, the exchange rate, whatever you want to kind of use that term. So, why do you think that it was kind of stagnant when it seemed like, inflation was almost imminent with the massive amounts of money printing that we saw, kind of similar to the 2008-9 time? And, why is it, I guess, why was it kind of, I guess, a delayed reaction to start doing a little bit better than it is now?
Yeah, going back to you know to 2008 timeframe, when you had the big meltdown in the markets, gold at the time then was used as a source of liquidity, and gold tends to do that. It's first a safe haven, but at some point it's used for liquidity because a lot of money managers and so forth don't want to just sell all their equities or their fixed income. They'd rather just sell the asset that doesn't have any interest or dividend attached to it, which typically would be gold. I mean, it's used sometimes as a hedge or as a non-correlated asset. So it's common to be liquidated when portfolio manager is trying to save the rest of his book, so to speak. Doesn't mean it's right, but and you have to go back in time a little bit, because in 2008 the futures markets and the leverage that was involved with precious metals was a lot greater than it was today. So you had a lot bigger swings in the market on the paper side that tended to influence the physical market, and which is kind of an interesting thing, because I think the gold and silver market are one of the few markets where the physical market is really dominated by the paper action, or structured products and that type of thing. So walking into 2020, when you had the March meltdown scenario, gold actually held up well to a certain point, but when eventually everything just gave way, like the levee broke, so to speak, it just started taking everything down with it. So silver went from like 16, 17 down to like $12, and gold took a beating, went down a couple $100. But when the Fed then kicked in, you have this sort of you know the other side of the equation is the money printing, the reaction to that, and the reaction to currency debasement, all that kind of stuff. And so there was so much creation of money at that time. Obviously it started lifting everything back up, and gold actually did rather well. I think it went to a new all-time high in 2020, in August of 2020, and then it kind of peaked out at that point. And that's actually at the same time the bond market actually topped, was around the same time gold actually peaked. And then the commodities themselves actually didn't start doing well until after gold peaked. And a lot of what I looked at the time in 2020 was gold started to be used as a carrying trade, I guess you could say, to start saying, listen, I think I could use gold as one leg of the position, and then I could go long commodities as the other leg. And so as a sort of like almost like a short gold, or sell gold and go long oil, or go long eggs, or whatever it may be, that because people were expecting the economy to start perking back up because of all the money printing and stimulus and all that type of stuff. So gold was sort of a carry trade for that period of time, for the next couple of years. And then it started getting its footing, obviously, when the Ukraine incident happened, and then gold took off again. And then it's been a sort of a rocky road, because then the Fed came in and started cutting rates and so forth, and that cutting rates, a lot of hedge funds, a lot of portfolio managers went to the playbook of, okay, they're going to be, I'm sorry, not cutting rates, but quantitative tightening. They started to remove money from the markets. So basically the playbook at that point was short anything and everything, including commodities, because traditionally when money supply gets tight, it has a negative impact on asset prices. Well, summer of last year, what ended up happening, which was very, very unique, is that the precious metals, gold, silver, platinum, palladium, started to sell off during that playbook of, June started to roll around, prices started to drop on a lot of different things. The paper price started diving a lot quicker than the physical price. And so you had this oddity with these backwardations where the physical price was actually, the spot price was actually more expensive than the near term or lead month futures contract, and that persisted for about 3 months. Usually those are very rare occurrences, and they only last for maybe a week or two, and it doesn't happen in all four precious metals at once. And in fact, it doesn't happen in gold very much at all, because gold is traditionally it has some degree of financing to it, or some type of collateralization to it, so that it there is some interest rate associated with gold. But the when all that started happening, India jumped into the picture and said, listen, if you're going to take silver down to below 21, we're just going to sit there and start buying everything that's not nailed down. And they started doing that. And so Western investors were selling things off, and you had portfolio managers and CTAs, commodity trading advisors, that were going net short metals and net short silver back in September. In fact, they went net short when they hit peak net short was about a day or two off of the actual low in silver itself. So um, uh, that it was a paper phenomenon that drove metal prices into the ground. And then once things started to, the physical market started to exert itself, the shorts started covering, and they couldn't pressure it like they normally could have. And you started to see the metal prices lift, and then silver kind of take off into the end of the year. Gold then sort of rallied in January, had a strong January, and then had a big pullback in February. And of course, then the banking crisis happened and everything exploded. And you kind of see what's happening right now, where the gold and silver are moving more on a factor of mistrust and confidence, I think, than they are anything else right now, because the Fed is still raising rates. They're still trying to tighten, I guess you could say, well, quasi tighten, because they just added $300 billion or expanded their balance sheet by $300 billion when the banking crisis happened. So that basically negated some of the QT that they were doing 6 months prior. But it's really a game of chicken at this point. It's a worry of, hey, listen, it's not a return on my money anymore. Now it's a return of my money. And so it's trying to identify from an investor standpoint, where's the safe places to go? Is it treasuries? Is it do I throw it into the stock market? Do I go into private equity or whatever it may be? Is just a lot of that stuff that's going on right now, trying to understand the long-term ramifications. If the markets get volatile and choppy again, will the Fed come in? If the banks start to go under again, will the Fed come in and blast off money supply? Because really, in essence, we're in a situation where the system needs liquidity to survive, and it needs liquidity you know more for refinancing all this debt that constantly comes due. It rolls on a constant basis. So you have just so much money each year, or so much debt each year, that has to be financed somehow. And that's one of the problems that the Fed has right now, is that they're trying to curtail money supply, which is trying to attack inflation, but at the same time they're disrupting the natural flow of refinancing and repo activity from the bank side, and that's creating some of this massive volatility, I guess you could say. So and so to bring it back to simplicity, I guess, with gold and silver, the idea behind buying physical metals is partly saying, listen, the Fed at some point is going to have to increase money supply or increase liquidity if they're ever going to try and get the economy back into gear again, or or more so finance the U.S. government deficits that right now we've been stuck in this sort of debt limit ceiling situation. If the debt ceiling limit gets lifted, uh, the U.S. government's going to come to market with more debt. They're going to need to have that financed. Who's going to actually finance that? Is it going to come out of the financial markets and basically have a crowding out effect, where stocks go down in order to satisfy U.S. Treasury's demand for capital? Or is it going to be going back to the days where the Fed, the last couple of years when they were doing QE, was financing 90+% of all the issuances. And so with banks sort of on the ropes, it's harder for the primary dealers to absorb, a massive wave of new treasury issuance without the help of the Fed.
So yeah, you kind of alluded to it, right? The banking crisis that we're seeing in here right now, which it seems like is kind of causing a lot of panic in the markets, right? There's a lot of volatility. We saw FRC, First Republic Bank, kind of crash, and that stock was moving in 40% plus swings in like one day. They even halted trading on it because of how volatile it was being. Do you think that this is like a positive for gold? I mean, and I know you kind of alluded to it a little bit earlier, but with gold and silver and whatnot, like obviously you guys are very insured, and you have the history of kind of storing and everything like that. But it seems like before, the banks were kind of the safe haven, right? Do you think that it's gonna the narrative is gonna kind of switch where maybe the safe haven's going to start to be, maybe the precious metals, just because of like, the insurance policies that you kind of laid out earlier, and like some of those things, like the backing that some of these companies, need to have in order to hold precious metals. Seems like it's more than it is for a bank. So I don't know if you want to kind of get into the differences there, but do you
Yeah.
kind of think that that helps in a sense?
Yeah, there's a degree of confidence that you have to have as a depository. Having a Lloyd's of London policy is critical. Lloyd's is really the only one that it's a more of a marketplace, but it's really um, it's a marketplace place that brings together a lot of different insurance companies that can take on that type of exposure together versus one insurance company that covers the entire facility. No, but no one insurance company would take that kind of exposure. So it helps to having that, there's a degree of, it's sort of like almost like a having that Lloyd's policy. There is some ramifications, there's some responsibilities, there's surveys that are done from a security standpoint that gives the lead underwriter assurances that, hey, listen, there is structure to this depository, there's a role and responsibility by staff, and you have the cameras and the sensors and all that kind of stuff there, it's there, and it's been documented and so forth. So that helps bring legitimacy to a depository. You want to obviously stay away from depositories that don't offer any insurance whatsoever, and they say, listen, it's up to you to get the insurance. That's not necessarily the brightest thing, or that could be a red flag, for the client to look at. Um, from a standpoint of safety, it is important to understand that the precious metals markets, the cash market, and depositories are largely unregulated. That it literally is the Wild West out there. You have, when it comes to buying precious metals, you really have to, as a consumer, do your due diligence, understand who you're actually buying from, because that same gold eagle coin could be 20 different dealers selling it at 20 different prices. And when you go to sell it back, there's what they call a spread between what you buy it for and what you sell it for, and that spread can be rather wide, especially in the silver market. There's a lot of because of that unregulated type of atmosphere, there's a lot of dealers that take a lot of advantage, especially of older clientele, or retired people that may not understand how the market works and so forth, especially in this day and age where a lot of people have come into this market because of fear, because of worry and concern, and not really being an avid precious metals person beforehand, really living in the world of CDs and stocks and bonds. People can get taken advantage of very easily. So that's important to do your due diligence, try and read and understand as much as you can. Certainly with clients of ours, they can call in, I can educate them and give them some pointers and tips of what to look for, what the questions to ask for. In fact, on our website, we have a full array of articles and videos that I've done that explains what to look for in a depository, that type of setting. A lot of the different questions to look for, the going concern risk, the different structures that depository may be operating under, not just as a depository, but also as a dealer or as another type of institution or company. And the depository is only a small ancillary business of that. So you have to be careful with, if the economy goes down, does it take down the parent company with it? And of course, then you don't want to be in a situation where you're trying to get your metals out of a potential receivership type of issue, like we just had with First State Depository going under. People have been waiting 6 months, 9 months to get their metals out, and then the costs associated with trying to get their metals out. So there's a lot of knowledge, I guess, you have to really understand and try to ask a lot of detailed questions on. Ask questions that may not be, that may be sort of in your face type of questions to that depository or to that dealer. Don't be nice about it. It's your money. Demand answers. Especially if it's uncomfortable questions. Don't be afraid to ask them, because if if the person on the other end of the line doesn't want to answer that question, that might be a red flag. So that's something to try and it's just like buying a car. You're asking you want to kick the tires, you want to understand all the bells and whistles to it. Same thing with our industry. So, yeah, that's important, especially with regard to the markets, how they're acting right now. A lot of people are trying to understand in terms of, hey, listen, as my you see it a lot with high net worth individuals above the $250,000 mark with FDIC protection. They want to maybe put some of this away where gold and silver doesn't have any counterparty risk to it when it's held directly, and it's important to understand what held directly means. Whether you're holding it at your house or you have it with a depository in a segregated environment where you have a direct account or direct relationship with that depository, you hold it directly, and so therefore you don't rely on an intermediary or a third party or a dealer to settle that trade or be the in-between party between you and the depository. So understanding all that makeup is important, because at the end of the day, while you buy metals, one of the reasons is that it's an insurance policy. It's there as protection in case everything else kind of goes to hell in a handbasket, so to speak. Or what a lot of high net worth individuals are doing now is they're buying metals because they're concerned about political risk. They're concerned about future taxation policy or social policy. So you have, for example, the Trump tax cuts back in 2017. Those provisions, those sunset provisions, I guess, are going to come due, or the personal tax rates are going to start reverting back to the 2017 tax rates. So personal income taxes are going to start rising again in 2025. So a lot of people are saying, listen, at some point, maybe the best thing is to have it in a bearer asset form. So from an estate planning perspective, or from a standpoint of, I don't know what the world's going to look like 2 or 3 years from now, at least I know I have an asset that's lasted through centuries and empires and civilizations, and it's still around. And so it's just sometimes human behavior or human nature is to what you can hold in your hand is what you can trust.
Yeah, no, for sure. And it definitely seems like that's the way, but it's interesting. You kind of brought up like high net worth individuals because I kind of want to dive into that because it always seems like as a younger generation, right? I mean, there hasn't been a much appeal to the gold and silver, like the precious metals market. So what are you kind of, I guess, doing to help like appeal to that kind of market? And why do you think that obviously it's not financial advice or anything like that, but for somebody that's a little bit younger, where you're seeing a lot of inflation, like what is I guess the appeal to the metals that you think that everybody should probably allocate some portion of their portfolio to?
Yeah, especially for the younger generation, I think it's a wonderful. Crypto has done wonders, I think, for the younger generation to kind of understand money itself. The debasement of currency, how maybe the markets work, the idea that central banks are there to potentially create inflation, which is ultimately making someone's cost of living go up, where at the same time maybe their income levels aren't keeping up with that cost of living. And so I think the crypto market has definitely done a great job of trying to educate its way into the younger generation. The metals are an interesting asset class because it's has stood the test of time. I mean, it's been around for 5,000 years. So for the basically someone to say, listen, I like the smoke and mirrors of technology, and the metals are for all the old people. Maybe so, but the advantage of gold and silver is, one, you can pass it down from generation to generation. It's something you can hold in your hand. It's a bearer asset. It's something you can use to barter with. You don't need to have any type of uh, uh, settlement or nodes or any type of financial structure to be able to settle that transaction. And, if you want to pay your neighbor to mow your lawn, you give them a silver dollar or silver coin. You don't have to record that transaction with through like you typically do, like with Bitcoin or anything else. It's a very private oriented type of system that's been around forever. So it's it's, I guess it adds simplicity to the equation versus in this day and age of technology and AI and all this other stuff. Sometimes it's nice to be able to kind of just recharge your batteries a little bit and have something that's just outside the system. And a lot of people like just the appeal of looking at it, collecting these coins or bars, whatever it may be, or getting into maybe the older coins once you've had a portfolio of bullion, so to speak, and you wanted to venture out. A lot of people tend to see, hey, listen, this is history I'm holding in my hand. So yeah, it's for some it may be a great appeal to that.
Yeah, and that makes a lot of sense, right? I mean that's kind of like the argument, right? It's the original hard money, right? I mean, you throw a gold coin on your desk or on a table or something, you're going to hear it cling a couple times here or there, to say the very least. And yeah, I mean, it's been around for quite some time, but what I think is interesting is that typically it's been looked at as an inflation hedge. And when we're having like massive amounts of inflation right now, and there's it seems like a looming recession. So, when gold is kind of, I guess, like a flight to safety, or some of the other precious metals, like it seems like for me, it's always the narrative is surrounding around gold. Well, is it kind of like, I guess, I don't know, maybe like, a major growth tech stock like like an Apple or a Microsoft or something like that, where majority of the other stocks kind of follow these bigger players, where it's like majority of these other precious metals kind of follow gold. Is it something along those lines, or is there I guess a scenario where maybe some other precious metal kind of outperforms gold or outperforms the entire, I guess, precious metal market?
Yeah, you had like rhodium, for example, go from 1,000 or $800 an ounce to, I think it was like 26,000 dollars an ounce. Just a few years ago. Yeah, not too long ago actually. Um, silver is one of the few assets out there that's below its 1980 high. I mean, try and name another metal that is below 1980s highs, or below 1980s prices for that matter. It's been an asset that's there's a lot of nuance that goes on with silver, in terms of it's 70% of, for example, with silver, 70% is a byproduct of other mining. So it's not all just primary silver producers that mine it. So you have gold mines, copper, lead, zinc. They'll mine as part of that primary metal. They'll mine some silver, and so it's sort of a byproduct. Um, but it's just one of those things that the metals tend to do really well in certain periods of time. It's not the greatest asset all the time. It does well when you have uncertainty, and that uncertainty can be in different forms, whether it's political uncertainty, whether it's financial uncertainty, whether it's counterparty risk or systemic type of risk, where the people are saying, listen, the only way the government can get out of this mess is to print more money. And you tend to see that when the debt levels are through the roof. And you're talking over $30 trillion in debt with the Treasury. You're talking massive credit card debt. You name any metric, and it's going to be extremely high with whatever debt, private equity, or sorry, private company debt or public company debt, all that type of stuff. And you're seeing it now with the bank market or the banking stocks, having been forced to buy all this low yielding debt a couple of years ago. Now that the mark to market kind of came into or I should say, now that rates had come back up, and then people that are tired of getting 0.3% at the checking account or the savings account saw that, hey, I can get 5% in a treasury money market account or a T-bill. You started seeing that migration, and that's something that the Fed may not have seen coming. And it's just something very simple like that starts this the ball rolling, so to speak, rolling downhill, and it starts to pick up speed. And the problem you have in our markets is we don't always see what's coming down the road. It's impossible to see the next event or the next geopolitical event, or whether Taiwan, something happens there, or those are the types of things that gold and silver tend to be. That's when they tend to shine. no pun intended. But it allows that non-correlated feature of the market. It allows that part of the portfolio to hold its ground when typically maybe the stock market or other markets, like last year, you had the stock and bond markets get whacked. Um, and sorry about that. Let me just, um, you had uh, you had the stock and bond markets get whacked in last year, and gold and silver, actually silver was up on the year, and gold was just pretty much flat on the year. So that they did their job, and that's something that I think the market is starting to wake up and realize and say, hey, listen, silver isn't just this fly by night volatile rocket ship that goes all over the place. It just withstood one of the largest percentage increases of interest rates by the Federal Reserve in the last 50 years, and it was actually up on the year. And so you start to see questions get asked, and you start to see maybe institutions and more investors look at this asset class and say, maybe there's something here. There's potential value here that hasn't been really unlocked since maybe 2011 when silver was at $50 back then. But the way the charts look and the way you see the market uh, act, and you see the structure of the market, there's accumulation that's going on under the surface. You're seeing this, and you just look at India. The amount of silver that they bought last year when it broke under 21 was just incredible. And so you have somewhat of what they call a floor, I think, in the market, where other countries are coming in and just saying, listen, we're going to buy everything that's not nailed down. And that's, again, you have cost of production of silver, especially amongst the primary producers, which is around $21 an ounce. You have, gold's cost of production is between $1,500 and $1,600 an ounce. So those tend to be bottoms in the market. And we just saw a big bottom last year in the metals markets, and then it just came roaring off of that low. Especially the market got very, very negative, going into the fall. And I think it got negative really because it was paper selling that was driving it down. It wasn't that everyone was just walking away from any interest in the physical metal. There was a lot of tightness in the market that was developing last year, and you saw it in again the backwardation and the amount of inventory that came off of the exchanges, whether it's London or New York.
Yeah, and it definitely seems like there's going to be potentially, I guess, some increase in the asset classes just as a whole, kind of going forward. So is that something that you kind of I guess project out? I mean, obviously it's not any like financial advice or anything, but yeah, I mean, there's a lot of uncertainty. The younger generation has kind of played with a lot of volatility lately, whether it's some alternate crypto coin, or it's some GameStop or AMC, some of these meme stocks, things like that. So do you think, I guess, that there's going to be almost like kind of a reversion from that and more of a flock towards I guess some more stability, where like the precious metals are generally known as that. They're not really known to have I forgot the metal that you named earlier, but it basically like 3x in a
Yeah,
year.
yeah, rhodium. Yeah,
Yeah,
it went from 1,000. That went 25x or something like that. Something crazy. No,
yeah.
you're absolutely right. The metals aren't going to be like a Bitcoin. It's not designed to be like a Bitcoin. It's not designed to have the massive appeal and leverage and off exchange type of platforms that you can do with some of the cryptos out there. But then again, it's not going to have these massive waterfall events, or it's not going to have where these crypto exchanges go under and take your money with it. It's really designed. It's like the tortoise and the hare, I guess, if you want to look at a fable or nursery rhyme type of thing. It's a slow, steady type of time in the market versus timing the market. And yes, there's a lot of people that trade gold and silver. You certainly can make money doing that. You could go onto the futures market and leverage and get that type of activity. But at the end of the day, most people that buy physical metal are more interested in saying, hey, listen, I made some money in another investment, or I'm making money via income, and I want to protect that, and I want to put it away just like I would maybe into a savings account. And now that inflation and we see the system for what it is, the the liquidation, or I'm sorry, the liquidity that has to be created to keep this whole system afloat. The Fed can try and curtail money supply for a certain period of time, but you obviously see the effects of it, with the banking, funding of banks and that type of thing. So I think more and more people are waking up, and it's great that the younger generation is seeing this. Is that they see the idea that, hey, there has to be money printing. There's no other way out of this mess. Otherwise, we're the ones that are going to be forced to kind of cover this whole thing, 15, 20 years from now. And that's not fair. I mean, it's certainly, the younger generation is walking into a real, money pit, I guess you could say. And the question is, how do they protect themselves? If the only way out of this mess is to print more money, you want to have an asset that has some degree of longevity, some degree of tradition to it, that has been around a long time, and that will, over time, try to protect the purchasing power of the dollar that you're earning. And I think that's one of the benefits of the precious metals. Again, the important thing is buying the metals from reputable dealers and not overpaying, in terms of premiums, because there's a lot of dealers out there that have taken advantage of a lot of different investors, young or old, by you know overcharging massive premiums. You're seeing, the CFTC, Commodities Futures Trading Commission, go after a few of them this last year. So you definitely want to do your research, but there is, I think, a great, segment of a portion of your portfolio that you could segment to gold and silver. Personally, I think silver, in just in the hedge fund that I manage, just for full disclosure, I'm 70% weighted to silver, 30% weighted to gold. And the idea behind that is, one of them is that the relative valuation of silver relative to gold, I think, is much more. I think silver is much more undervalued, and you can see that in the gold silver ratio. Traditionally, over the last 500 years, gold and silver, that ratio has been, 15 to 1, 10 or 15 to 1. And naturally, silver to gold in the ground, there's about 8 ounces to 9 ounces of silver for every 1 ounce of gold in the ground. But why it's at 80 to 1, for example, and it's been there for quite some time, it may have a reversion of the mean back down toward 30 or 20 to 1. So buying silver now, you could then convert that to maybe gold later and get more ounces of gold for your money. It's just certain things that people can play with a little bit. They don't have to just buy a set amount of ounces of this or that. If they want to try and say, listen, I see some value, and this may be a great way to maybe add, a little bit extra, alpha to my portfolio. You buy maybe some silver. And then you look at, the platinum to gold ratio. Typically, platinum is usually more expensive than gold, and it's been relatively very cheap to gold, especially also to palladium, for the last few years. And platinum is starting to wake up as well. You're starting to see, the story behind platinum is really because of the supply issues out of South Africa, and the potential of deficits and tightness of market that will persist. And I think, that might be something for someone to watch. Yeah, it's just, again, it's a different appeal than crypto and Bitcoin, but again, it's going to have different attributes, and it's going to react to the market differently as well.
Yeah, and I mean it's more about, like, I guess I think, like, portfolio balance and, like, structure, right? Like, I mean, I that's where I kind of can see this fitting in, right? I mean, you know, uh, when you kind of go through that, I guess, the personal finance journey, so to speak, like when I was kind of first going through and, like, learning about, how to create your wealth and other things like that, like there's a big aspect that people talk about as diversification, right? And part of diversification is to kind of protect you from these difficult times, which seem to be looming ahead, right? With the Fed raising interest rates, banks failing, all that kind of stuff. So if you go all into a stock like, I don't know, like Tesla, for example, or even like crypto. Yeah, like you don't even have to mention crypto. You can just mention a stock at this point because of how volatile the stock market's been. it was up 90% in January. Sure, that's great, but at the end of the day, it also could go down 90% in a month as well. And so, like, theoretically, if you needed that money and your value of that $100 that you needed is now $10, you're kind of shit out of luck at that point. So, this is something where, you guys provide liquidity. It's relatively stable. Like, you're not going to see any big moves day to day. Your money's kind of safe there. And theoretically it could increase over the year, because it, generally speaking, performs well during these tougher times. So for me personally, I can see the argument to kind of flock towards the precious metals, especially right now. When you're seeing just like kind of like, yeah, like I've said, like difficult economic times ahead. But when it comes to all of that, and you guys have obviously the goldsilvervault.com, like you have the Idaho Armored Vaults, like all that kind of stuff. Like, what are you most looking forward to, like, for the rest of the year? Do you guys have any other big plans, or just for, I guess, the company in general? Because we've been kind of talking about the market. So relative to your company, do you guys have any big plans, or anything that you can, I guess, disclose here, or maybe it's something personal that you got going on that you're looking forward to the rest of the year?
A vacation would be nice. Yeah, we're actually working on disrupting the industry, the metals industry. We're getting ready to roll out an online trading platform to buy metals at prices that we very close to what we have right now, right on our website. Where people can call in and buy over the phone with us. We're basically going to try to reach with the website. And make it a little bit easier for people to get a lot better prices. We've been able to save people on average $2 to $5 an ounce for silver, just in a savings of premiums. And so what that basically entails is the way the industry works currently is that, especially for people that want to store metals, for example, they'll tend to say, well, listen, that place charges X amount to store, and this one charges that much more. I'll just go with the cheaper one. But what they don't realize is the transactional expense to get that metal is really where the industry makes all their money. So we tend to save people about 5 to 8 years worth of storage fees just from the transactional savings of buying the metal in the first place. And so, but we also do drop shipping. We can send to the client as well. So if they don't want to store, if they're just accumulating, or they just want to hold it on themselves, or at their house, that type of thing, they can certainly do that. It's something that we always try to. I want people to experience this market. I think it's a great asset class to be in at this point in time. You certainly haven't seen euphoria in the metals at all. You haven't seen that fever, I guess you could say, and you'll know when that comes. I mean, silver moves like a hockey stick when that time comes. It just goes vertical, kind of like the nickel market. When you see that vertical launch, that's the time that, okay, you're probably going to start unloading. Because everyone is wanting to get in, and it's exciting to be there. Just like when Bitcoin went to 64,000, whatever, the public was jumping in, because they want to be part of that excitement. It's the madness of crowds, I guess you could say. But you haven't seen that yet with the metals. That's coming, and that when that comes, it's not going to be that, hey, listen, our environment, in the United States, or maybe in the world, is that great. There's going to be a lot of concern out there, because the metals typically move more on a fear driven mentality than a greed mentality. And you have to also remember, for the younger generation, there's a lot more people outside the United States. We're just a small portion of the overall population. There are a lot of countries that still view precious metals as a great investment. As for example, in many different cultures, what you wear around your neck is what you own, and so gold is looked at as a savings account that you basically just wear instead of put into a bank. So you still have a lot of tradition out there that looks at the metals maybe a little bit differently than Western investors. So that's something to kind of look at as well. And this is unlike 1980, which was more U.S. centric. Now we're looking at a global financial system that has debt piled up to its eyeballs in every country out there. And on top of that, this is the first time in human history that basically we are a completely fiat driven world. There is no currency that's backed by gold anymore. So there is a lot of debt, a lot of money, fiat money that's just backed by total confidence. There is nothing backing it. So, uh, yeah, again, and I think that's one of the beautiful things that, maybe Bitcoin has kind of brought to the forefront is people understanding, maybe through technology, but understanding at least that, hey, listen, the dollar isn't really backed by anything anymore. It was taken off the gold standard in 71 and so forth. And that's when you started to see inflation lift. Of course, all asset prices, started going up, but not only with asset prices going up, cost of living also went up as well. And I think that's we're walking into an atmosphere right now where if you start to see um, any type of recession that starts to poke its head here, in any type of potential unemployment that starts to rise, that could really start hitting social instability, I guess you could say. People that saying, listen, I can't afford, you know, groceries now, or I don't have, more than $1,000 in terms of emergency savings. Well, wait, what happens when you start to see people lose jobs? We've just lived in an era the last 3 years, which was packed with stimulus and moratoriums on paying rent and paying your mortgage and paying your automobile and your student loans. Imagine now you're being forced to pay all these things at a time when the Fed is raising rates to try and curb the economy, which is in their intention is trying to curb inflation, which ends up, taking you right out of a job.
Yeah, and it seems like it's like the never-ending cycle, right? I mean, it doesn't seem like there's any good way that this really ends. I mean, I think there was even like I don't know if it was real or not. Some people are saying it might have been AI, but Jerome Powell got duped. I don't know if you saw that. He got duped
Oh yeah, yeah,
with
video, yes,
basically saying that a recession is imminent. So, I mean, if he's even saying it, I guess we have to believe it at this point. I don't know anybody that can really deny it, what's kind of ahead. And, the way that Powell's kind of lined it up, there's going to be more pain with unemployment. Now he's saying that there's definitely going to be a recession with raising rates. But his, reasoning is because that's the only way that they really know how to fight inflation. So, all in all, like, I mean, it's making a solid argument for the precious metals. Obviously, it's not financial advice or anything like that, but yeah, I mean, I really appreciate you coming on here, Bob, and coming to
sure.
talk to me a little bit about precious metals. Like, I haven't had anybody kind of take a deep dive into this market yet, so I think it's an interesting one, and that you guys definitely provide like a great service for the average person to kind of get in on it. So on that note, why don't you tell people where they could find you and what you got going on?
Yeah, definitely. Our website is www.goldsilvervault.com, just all one word. We're located in Idaho. We run one of the larger private depositories in the country. We also provide logistics support as well, and then we can also uh, buy and sell metals, make a two-way market. We can help with delivery of metals. We can help with logistical support if you're, say you just accumulated metal, or maybe you inherited some metal and you just don't know what to do with it, or maybe you just don't want to store it in the house, so to speak. We can help move that metal or bring it to our facility. There's certainly different ways to try and help the individual out there, trying to protect their portfolio. But what we do is more in terms of when it's called asset protection. When you're dealing with a physical asset, we're literally safeguarding people's, retirements, or the college education, or an estate, or whatever you want to call it. That's what we do. And I think that's what the metals represent. It's more than just simply just bare bullion, or coins or bars. It represents people's trust in the system, or their hard-earned dollars. And I think that's the way you have to kind of look at, just like with any investment out there. Just try to temper the emotions, I guess, of the market. The advantage with owning a physical item, for example, you may be not as tempted to buy and sell as fast, because you don't. It's a little bit harder to unload, so to speak, versus just mouse clicking, a stock, or a cryptocurrency or something of that nature. So it tends to make you focus more on the long term, and I think that's one of the advantages that the metals have. But yeah, it's from that standpoint, I'm also a registered investment advisor as well. So a lot of times I can help clients sort of understand the markets a little bit, understand especially when it comes to the physical metals, how the market's structured, what's affecting the market prices, and what players are doing out there. I get into all that kind of stuff.
Yeah, it's awesome stuff. You should check out goldsilvervault.com. And also, you didn't even plug your Twitter. What is
Oh,
Profit Plus ID? Yeah, so I mean, I'll link all that. I mean, you get on Twitter Spaces, you've come on mine as well. And I'm sure you'll be popping in here in the near future as well. So yeah, overall great stuff. And Bob, thanks so much for your time, man.
sure. I appreciate it. Thank you again.